I want to talk about a mistake I see way too many new real estate investors make, and honestly, I made it myself early on. It's not about buying the wrong property or overpaying on a deal. It's something quieter, something that drains your money slowly, almost invisibly, every single year. I'm talking about running your real estate income as a sole proprietorship and not realizing how brutal the tax consequences really are. When I first started, the simplicity felt great. No fancy setup, no paperwork, no extra forms. I was collecting rent, tracking expenses, and reporting everything on my personal return. It felt clean. It felt efficient. And most importantly, it felt familiar. But what I didn't realize at the time was that the tax code doesn't reward simple. It rewards structure. And the longer I stayed unstructured, the more money I was quietly bleeding out. Here's where things start to get real. As a sole proprietor, the government treats you and your business as the exact same thing. That means when your properties start producing real profit, you're not just paying income tax. You're also paying self-employment tax. And this is where most investors get blindsided. Employees split Social Security and Medicare taxes with their employer. As a sole proprietor, you or both, you pay the full amount yourself. That self-employment tax alone is 15.3%, applied to most of your net earnings. So let's say your rentals, flips, or real estate-related income clears $100,000 in profit. Before you even touch regular income tax, more than $14,000 is already gone. And that's before federal income tax, before state tax, before anything else. This is the moment where a lot of investors start wondering why scaling feels so hard. You're making more money, but somehow you feel poorer. You want to reinvest into another property, maybe renovate a unit, maybe save for the next deal. But the tax bill hits and suddenly your momentum stops. That's the tax treadmill. The harder you run, the faster it pushes back. What makes it worse is that paying self-employment tax doesn't replace income tax. You still owe that too. So that same $100,000 can easily shrink by 20, 30, even 35%. Once everything is factored in, yes, you can deduct half of your self-employment tax. But when you're writing five-figure checks, that deduction doesn't feel like much of a win. And then there's the audit risk, which almost nobody talks about. Sole proprietors are audited more often than other business structures, not necessarily because they're dishonest, but because the setup makes it easier to mix personal and business expenses. One bank account, one credit card, one blurry line between personal spending and investment activity. In real estate, that's dangerous. Travel expenses, mileage, home office deductions, repairs that are half personal and half rental use, those are all areas that get questioned. And if you can't clearly prove business purpose, deductions disappear fast. Then come penalties, then interest, and suddenly a profitable year turns into a financial headache. But taxes aren't even the biggest risk. The real danger is liability. As a sole proprietor, there is no legal separation between you and your business. If a tenant gets hurt, if a contractor sues, if something goes wrong on a property, your personal assets are exposed. Your savings, your car, even your home could be on the line. You're basically betting your entire financial future on the idea that nothing will ever go wrong. And in real estate, that's not a smart bet. This is why at a certain point, upgrading your structure isn't optional. It's strategic. For me, that shift was moving into an LLC, not because it instantly lowers taxes, but because it creates separation. It protects you, and more importantly, it gives you options. By default, a single-member LLC is still taxed the same way, but now you can choose how you're taxed. And this is where things change. When you pair an LLC with an S-corporation election, you unlock a powerful tax strategy that many investors never learn about. Instead of all your profit being hit with self-employment tax, you split the income. You pay yourself a reasonable salary, which is taxed like payroll, and then you take the rest as distributions. Those distributions are not subject to self-employment tax. Using that same $100,000 example, imagine paying yourself $60,000 as a salary. Payroll taxes apply. They're The remaining $40,000 comes to you as distributions, without self-employment tax attached. That alone can mean saving $5,000 to $7,000 every single year. And the higher your income climbs, the bigger that gap becomes. Over time, those savings compound. That's money you can use for down payments, renovations, reserves, or long-term investments. That's how structure quietly accelerates wealth. Now, this move isn't for everyone right away. There's a specific window where it makes sense. Usually when income becomes consistent and meaningful. Yes, there's more paperwork. Yes, there's payroll. Yes, you need clean books. But that structure is exactly what the tax system rewards. And that's the real takeaway here. This isn't just about tax forms. It's about mindset. Successful real estate investors don't just focus on cash flow. They focus on protection. They focus on efficiency. They focus on keeping more of what they earn while reducing risk. A sole proprietorship might help you start, but it rarely helps you scale. If you're serious about building long-term wealth through real estate, about protecting what you've worked for, and about playing the long game, then structure isn't an expense. It's a strategy. Because the goal isn't just to make money, it's to keep it, protect it, and use it to build something that lasts.